Okay, good afternoon, everybody, and welcome to this afternoon's session. For the next half an hour, 40 minutes, I'm going to talk to you about the second stage. So following on from last week, hopefully some of you were able to attend last week and you're back again today to hear a little bit more about the whole process and what's involved. So I'm going to take it to the next step then in this afternoon session, and it's what the banks look at or what the banks look for when you're buying a house, and the process, the stages involved in buying a house. So we've kind of have it narrowed down or marked down to 10 steps. As ever, please use the chat function there to send in the questions, and the guys at Umbrella Wellness will send around a copy of the slides once I get them over later on today based on feedback. And obviously the webinar is recorded for posterity purposes. So without further ado, getting straight into it. Obviously you'll have heard about us last week, who we are. If it's the first time you're listening in, we're a brokerage independent firm based over in Dunboyne in County Meath. We are a financial planning company and we deal with all elements of finances. So we're obviously going to focus in on mortgages this afternoon. So getting straight into it. So what are we talking about when we're referring to the mortgage process? We're basically going to look at what they use, what they base their decisions on. We're going to look at the mortgage, how it works. We're going to look at the process of buying that home. Maybe you already own a home. So some of you might be listening in here today and you may already own a home, which again is great. Help to buy. Not really going to get into that in any great detail because we did cover it to an extent last week. And then the costs associated, I will actually touch on that because that's something a lot of people aren't aware of. So the extra costs, and when you're applying for mortgage, that has to be taken into account. So straight into it. So what do the lenders look at? Well, obviously common sense will tell you they're going to assess it based on your income. So how much are you earning? And it's not just as simple as how much you're earning. It's your income, your basic income, your overtime, your allowances, your shift work, your bonuses, commission. And literally every bank looks at the different elements of pay, and how it's made up. On top of that, how long have you worked for your employer? Again, if you're less than 3 years, then you won't be able to use all of these additional allowances with a couple of the banks, whereas some banks only require you to be with the existing employer for 1 year if you have variable income that you want to include. Then you have what's called the mortgage service ratio. It's how much of your net income can you use to pay for that mortgage payment. It's called debt service ratio, but obviously this is in relation to mortgage debt. So if you have other debt included, so car finance or other kind of credit union loans, then that's all taken into account in relation to how much of your salary you can allocate for debt, DEBT. Okay, so again, a lot of people may not be aware of that. If you have any rental income or you're renting a room, does that apply, and how is that going to be taken into account with the banks? Again, something as simple as owning a home and renting a room. Some lenders look upon that negatively, and some of them just look upon it as, well, you're renting a room, so fair play to you. So it's not as straightforward as just saying, okay, can I rent a room? And it depends on which bank you're approaching. Okay. In relation to your employment status, then, are you permanent? Are you on a contract? The meeting I just had literally before this webinar started was with a guy who couldn't get a mortgage with one of the high street banks. He's halfway through a self-build in Carlow and struggling to get a mortgage. I've just had a meeting with him and we get into finance. I rang a bank. So just to put into context how we work as opposed to going directly with a bank, I went straight to the bank after the meeting, and by 11:45, just before we started, I had rang him back to say, yep, we've got a green light and I need the following information from your engineer and from himself to be able to proceed. Whereas he'd been dealing with a different high street bank who had said, no, come back to us in 6 to 12 months. The guy's already at first fix stage. So he's ready to plaster the house, just to put it into context. So, it's just the way it works with one bank versus another. He's on a contract, but one bank will look on it differently than the next bank. Okay. Equally so if you're self-employed or if you're a contractor. So this is where you're working for yourself, but maybe via this umbrella company structure. Again, nobody listening in today is going to fall into that category because you're all employed, but your partners or your spouses may fall into that contract, self-employed contractor type role. Again, public sector versus private sector. Some of you listening, I have had some public sector people listening into the webinars. or public funded bodies listening in. If you're in again today, you're welcome. It's a little bit different for public sector because you do normally have a 12-month probation. Some public bodies or government funded bodies may not have any permanency for a 2 to 3 year period. Again, there's ways around how we approach that with the banks, and which banks will look favorably upon these applications. So it's not just a one size fit all, which hopefully you all got from the webinar last week. Again, if you're contracting as a self-employed individual, it's definitely a minimum of 12 months, but for most banks, it's going to be a minimum of 2 years. Okay. And that's just what we've written there. So again, you'll have these slides to read through that detail in your own time, in a bit more detail, in a bit more with a bit more focus, and then you can come back to us with the questions you might have. Other things are your outgoings. So basically your money management. I have put in there children to start. Children are expensive. If you have children, that does reduce your affordability and your ability to borrow. I'm not here telling you not to have kids. Obviously, I'm not. I have 3 myself. But in relation to the mortgage process, it can impact your ability to borrow. The other thing that a lot of people may not take into account, and we often ask the question of young couples, is if there is potential for kids, then it's the whole maternity leave. Will your employer pay maternity? Will they not? Are you potentially going to be taking unpaid maternity? And if you do, I have cases sitting there right now where clients are on maternity leave, they're taking unpaid. We cannot progress those cases until they're back on pay, with the first pay slip showing they're back at work. Other examples, where we're dealing with a case at the moment where, again, it came through Umbrella Wellness, but the wife is a teacher and she's taken parental leave and her pay slips are all over the shop. So we need her to work in a structure that the banks will accept. Otherwise, we need to wait until she's back off, parental leave. And that's not necessarily a nice conversation to have with a mortgage applicant. But at the end of the day, if they want to have a mortgage, they have to fit the bank's process, not the bank fit their situation. Okay. So children can complicate the whole part of not only outgoings and not only affordability, but also the maternity piece. In relation to rent, you've got this proven repayment ability. Rent will cover proven repayment ability along with savings. A lot of people overlook that. Again, meeting I had last night, clients looking to, they're selling, they're looking to buy their new home. They thought the fact that their existing mortgage repayment, they're paying their existing mortgage, would provide them with repayment ability for the new mortgage, but they're looking for a larger mortgage. And they don't have proven repayment ability for the mortgage we're looking to take out. So now we're going to have to get them to clear a loan, which they hadn't planned to clear, as part of the sale of their house, to be able to provide the bank with proven repayment ability, or they're selling a house and they're not going to be able to buy their new house. So just little things that you need to be really, really aware of and clear on. Proven repayment ability is the first test. After you know how much you can borrow, PRA is the first test on the mortgage. Show the bank, and it's only over a 6-month period, that you via savings and or rent, that you can afford to take out the mortgage that you're proposing. Okay, really important stuff. Okay, also useful to identify if you have the potential to overpay your mortgage. And again, not really for today's session. That's more on a one-to-one. Once you understand the mortgage, can you overpay it? And obviously loan to value, again, we covered that last week. Do you have an existing loan? So the example I'm after using for the clients last night, they have an existing loan. They're going to have to clear that loan to provide them with the PRA, proven repayment ability. But equally so, existing loans can impact your amount you can borrow based on the debt service ratio or the mortgage service ratio figure I've given you earlier. It can impact your net disposable income. How much can you borrow if you're a serial borrower? Again, bearing in mind that the bank are going to be checking your credit report. So even though you may not have loans at the moment, you might be a serial borrower. So you might have taken numerous loans in the past. No issues with clearing those loans, but it's just your overall management of your money. What are they seeing when they're assessing your finances? And again, I'm not saying that you wouldn't get a mortgage if you're a serial borrower. If you're paying off that debt, that's great. We got asked last week, should you take out a loan to prove to the bank that you can pay back a loan? No, absolutely not. Complete nonsense. Save that money and save the interest that you would have paid on that loan instead. It's just it's a nonsense thing that banks have in the past told their clients purely to sell a loan. Equally so in terms of outstanding loans. So the client example last night, again, another real case scenario, it can be cleared with equity releases, or you can consolidate debt. We've got loads of that going on at the moment. What does that mean? It means where you have a house, you have a mortgage, but you've also got debt that you've taken out. You can consolidate that debt within a mortgage. Again, there's very smart ways to do that. You have to be aware of any potential added costs, but you can actually turn that on its head and utilize it significantly to your advantage. It's not for today because it takes about 10 minutes to explain it. But if you do have outstanding loans, bearing in mind that it all has to be taken into account, and it can be good and it can be bad. Okay. How much are you wanting to borrow? That's basically, that's going to be the multiple of 3.5 times. Or if you're looking for an exception, obviously more than 3.5 times, and I have a calculator to show you in a moment. The loan to value is obviously going to dictate the rate. So if I'm buying a house for 100,000 and I'm going to borrow 90, then I'm going to bring 10 grand to the table and I'm going to borrow 90%. If I borrowed 60k, I'm going to bring 40,000 to the table and I'm going to borrow 60%. So that's the loan to value percentage. And the lower that loan to value percentage, so if it's 80 to 90, that's the highest rates. If it's 60 to 80, that's the middle. And if it's less than 60, and with some banks less than 50, that's where the rates are at their lowest. So usually better rates as you lower the loan to value. Pardon me, I should have put that up first. So what else is relevant? Age. Again, we deal with a lot of people, who are looking to move home, maybe in their mid-40s. Banks will now allow you to borrow, in a lot of cases, up to age 70 if you're in a pension scheme with your employer. So even a 44, 45-year-old today can still squeeze 25 years out on a mortgage. They may not want to have that mortgage in place in 25 years' time, but the fact that they can borrow it and gets them to buy the house they want, and then they just have to be smart with their money and try and overpay it to have it cleared earlier than age 70. But again, the option is there. Obviously, what age are you now will dictate it, and it's not what age you are now, it's what age you are at your next birthday if it's more than 6 months since your last birthday. So again, I'm 40 or I'm 30, but I was 30 last June. Well, the likelihood is the mortgage is going to be based on 31 because that's closer than last June. Okay. What age will you be when it ends? Are you in a pension scheme? So not every bank will lend to 70. Some will only go to 65 if you're not in a pension scheme. Your money management, I've talked about that already, and I spoke about that last week. So how are you with regards to your finances? You'd be surprised how often we have a meeting with clients and we're telling them to go off and sort out their finances and come back to us in 3 months' time because their finances don't show affordability. This week alone, with what you would deem on paper well-to-do applicants, not high net worth, but certainly, good assets underneath their belt. This week alone, I have 3 people put on hold because we do not have good money management on their accounts. The PRA isn't there. So off they go, sort it out, fix whatever it is we've looked at. So we won't submit that application because if you submit it, then you're risking being declined. If you're declined on the mortgage, again, it's not the end of the world, but you then have to disclose that to the other banks if you do apply, because one of the questions with a lot of the banks is, have you been declined for a mortgage in the past? And then you're saying, yeah, I have, and why have you been declined? So you're opening a can of worms that you just have to wait for 2 or 3 months, okay, or maybe less in some cases, okay? So the ability to meet repayments, direct debit, standing orders, overdraft facilities, having referral fees where you're overrunning on what you're allowed in terms of overdraft, or if you don't have an overdraft and you're running into negative on your account, all of these things need to be looked at and managed, because when we assess your documentation, clients often say, and it's very common, if you end up proceeding with us, we'll be going down through your accounts and say, geez, you can't hide anything, and you can't. Now, it doesn't mean that it's going to impact on your application, but we have to identify what the weaknesses are and then put it in a way that the banks don't see it as big a weakness as it potentially is. Okay. Excessive gambling. I have a case going on at the moment where the chap has a lot of gambling going on, but we got a report from his Paddy Power account which showed that he's actually making money on his account. Now that's not normal, that's not common, and the banks are proceeding on the basis that he's actually making money on his regular gambling. Again, that's a very, very unique example of a gambling been assessed and approved by a bank. Okay. What else is relevant? Your credit history. There is only the one credit reference agency now, so we often get people saying, yeah, I checked my report last year with the ICB, the Irish Credit Bureau. They're now gone since October, so the only one in town now is the CCR. Let me put up that information. The reason why the CCR is it's important that you order it, is that you see what the bank sees. So the Central Credit Register, operated by the central bank since 2017, as a result of the IMF involvement in Ireland, controls and records all lending with, if it's over 500 euros, it's going to be on record with the CCR. The problem right now is it's taking ages to get the reports. It's up to 4 weeks at the moment. So if you don't have your CCR and you want to see what's on record with the credit agency, check out our website or come back to us and we'll send you instructions how to do it, because it's not straightforward either. How many of you are applying? What's your residential status? Again, I have a case going on at the moment where a chap is over and back between Ireland and the US. Again, you're putting that case around the different banks to try and find, you have to position it in a particular way to try and find if the banks will take it on. So again, these cases aren't straightforward. Equally so if you've come in from Ireland, come in from abroad. So, if you're in from Brazil or you're in from India, you're in from a country where you require a visa, then you need to provide the visa. And not every bank will accept every type of visa. Stamp 1, Stamp 1G, Stamp 4. Stamp 4 every bank will accept, but the Stamp 1, Stamp 1G, not everyone will accept. Okay. If you've been living abroad, you might also be required to get a credit report from the country where you were living. So I was in France or Australia or India or America or Brazil or wherever it is, South Africa, and I'm within the last 3 years. Depending on what bank you apply to, they may well look for a credit report from that country. Okay, the value of your property, again, is kind of repeating what I've said. Actually, what is relevant there though is the high value mortgages and the green rate mortgages. So if you are looking at buying a property that's going to have a BER rating of B3 or better, then you might be in a position where you can get a better interest rate from that particular bank. And equally so, you've got these high value mortgages. Again, that tends to be Bank of Ireland, Ulster Bank, who are pulling out, permanent TSB, where if you borrow a little bit extra, they will provide you with a lower interest rate. So things that you wouldn't necessarily be aware of. The meeting I had with the clients last night, just because it's fresh in my head, I went through 12 different mortgage products with one bank alone. So just to put that into context, when I was assessing their options and we're trying to get PRA, we looked at 12 different products with the one lender. Okay, so get your head around that. In relation to the mortgages, I come back to that as we progress. So the 10 steps then in relation to buying the house, it's nothing here is brain surgery. A lot of it's common sense. It's been good with your money, obviously been having a good job. Again, this week I had a meeting with a guy who's got income in the US and income in Trinity. He's been around the banks, coming to us. He's been referred on to see if we can help him. And at the end of the meeting, it's basically, we can't use the US income, even though it's a university income. It cannot be used. Highly qualified. That individual either needs to borrow less or they need to change their employment status and get some extra income in euros in Ireland, and well qualified to do it. So that's working to earn a good income. It's not just as simple as that. If you've got income coming from self-employed business or coming from abroad, that may not be accessible by the bank. Okay, and then you might get a bit upset about it, and it does happen. And say, well, why won't they accept it? It's just their policy. It's their mortgage products and the rules that they have around these things. So if you are looking at including income from abroad, that's typically called an FX loan, so foreign exchange loan. So you do have to look at what bank will take that on, and not many will. Not going to lie to you, it's not an easy case to get over the line. In relation to your living standards and how you save your money management, we've kind of touched on that. Are you looking at the 10% or the 20% deposit? So first time buyer, second time buyer, do you have the deposit? Are you getting a gift? Have you got inheritance? Again, this week alone, 3 or 4 cases where there's inheritance and some of them gifts in others. So you're then into letters from solicitors to confirm that it was an inheritance or a gift letter. You need a gift letter from the giftor, so from the parent in most cases. Affordability, proven affordability. Then you can come to us at any stage here, by the way. So I'm giving you a scenario here where I've dealt with clients at stage 1. I'm giving you scenarios there where I've dealt with clients at stage 2 this week alone, and I've dealt with clients at stage 4, 3, 4, 5, and 6 at every different level. Because you're not necessarily ready to apply at the beginning, so you might have to do a little bit of work, get your house in order, tidy things up a little bit before you can actually approach a bank. There's no point approaching a bank to be told no, and we just don't do it. So that's not our business model. We're not going to throw in an application to see how you get on. We'll tell you if you're going to get the mortgage. If you don't like what we're telling you, there's no barriers for you to go directly to a bank. But bearing in mind that that decline thing does then have to be disclosed down the line. Okay. So there's the stages. So what does it look like then? So the way we operate and the way most good companies are going to operate will be an initial consultation, to have a review of your situation, ask questions, get an idea what you're looking for, and then really to tell you what's possible. So manage your expectations is a huge part. Then off you go. When you're ready, you collect the documentation. This in itself can be hard. So you'd be surprised how easy and how hard some people make collecting bank statements, pay slips, employer summaries, credit reports, credit unions, saving statements, salary certs. Doesn't sound hard. And it isn't really, but some people do complicate it. Maybe you've got 7 or 8 bank accounts and you've got accounts here and accounts there, and some banks aren't great at getting you up-to-date statements, whereas other ones you can order them online. So I'm not going to get into knocking any bank here today, but you have different scenarios with the different banks. So you collect the documentation as per the checklist. We generally nail that checklist down specifically to you based on the initial meeting. Then you're into applying. So the application now, we get the meeting together, get the application ready to go. We do the cover note. We assess your bank accounts, identify transactions that we need to explain, get that in. And 3 weeks later, sooner for some banks, longer for others, you get your approval in principle. That's the approval from the bank to confirm now that you're good to borrow whatever the figure is, 200,000, 300,000, 400,000, 500,000, whatever it is that your salary is allowed and whatever it is that you want to borrow within the rules. The AIP will vary for validity up to 6 months. Some banks will say it'll be valid for 12, but in reality, it's not, because if it runs past 6 months, they're looking for up-to-date pay slips and bank statements anyway. So it's not much of a difference between the 6-month expiry or the 12 months. And if it runs over 12 months in terms of the process, then you're into a new declaration and a whole new raft of documentation. Okay. Assuming that you're successful though within that 6 months, now you're finding a house. Once you find the house, you pay a booking deposit, and that is a refundable deposit. Again, we get asked this a lot. What happens with that deposit when you pay it? That deposit is paid back to you if the deal doesn't go ahead. So it's where you pay 2.5 to, let's say, 10 grand to secure the property. You'll also need to show the estate agent that you have your AIP, your approval in principle document. Some banks will give you an AIP very easily. Some banks you have to wait to 3 to 4 weeks. So again, I recommend talking to us depending on where you're at. Don't stress it. Asking the experts as to what you do need to do and what you don't need to do takes a lot of the pressure off your shoulders. You're relying on the people who do this for a living to try and help you make sense out of the whole thing. And I've got little tips in a lot as we go along here. One of them that's worth reading there is you cannot view enough properties. Why is that? Because you get a feel for what, you might be looking at a property that's 110 square meters, and then you go and see 2 properties at 110 square meters. And the layout of both properties is completely different. One feels much roomier, another one feels more claustrophobic. Yet the size, as per the spec, is the exact same. You'd be amazed where space is lost on properties, or the bedrooms are too small, but the hallways are larger, or the hallways aren't large, are small, and the bathroom is huge. In some houses, you see this. It's crazy the way some houses are laid out, and the way stuff is squeezed in or not squeezed in. So you can't see enough houses to get a sense for what you want, okay? Especially if you're buying with a significant other. And in relation to where you're at now, you do need to have a solicitor engaged. Again, if you're in this process, or you're at this stage, you may have a solicitor. Don't go necessarily with the first solicitor. Get a few quotes. Find out how busy they are. Find out if they deal with the bank that you're looking to take the mortgage with. So if you're not dealing with Bank of Ireland, for example, you might be dealing with KBC, or you might be dealing with Avant. Which solicitors have experience in dealing with Avant's process? You'd be surprised how few solicitors deal with all the banks. And then because of that, they don't necessarily know how to deal with the legal process with the bank. And that can slow things down for you. So that's really important. You might want to get the house structurally surveyed. You do have to get it valued. Again, if you're dealing through ourselves, we coordinate all of that for you. The survey or the snagging, if it's a new build, is where you get somebody to come out and look at the house. I can give you loads of examples, but I don't have to. This week alone, poor girl, nurse up in Loud, buying a house. She works in the hospital there in Drogheda. She rang me yesterday. She was more disappointed to tell me, because this is her second house. The deal has fallen through because we got a good engineer to go and survey that house for her. She's buying on her own. I told her to be careful. Her parents told her there wasn't a need for a survey. She took our advice, thank God, got the house surveyed, had a builder in 3 months ago on this house to give her quotes on the works that she was going to get done. We sent a surveyor up, referred her on. Surveyor went up. There's asbestos in the roof. And pretty much what came back out of the engineer's report is the roof will have to be replaced. So that deal is gone. Now, why would the builder not have disclosed that to her when he was assessing the works? Because he mightn't have attention to detail, or possibly he saw, well, I'm not going to disclose it now. There's going to be a significant amount of work in this. And if the client is going to do the work, then they're going to have to get the roof replaced. And we'll be in situ at this stage, and there'll be extra bit of work in it. Now, that's me been facetious in terms of maybe the builder just didn't spot the asbestos. But if a builder's going out quoting to what works to be done in the house and didn't identify that, then either they're not a good builder or they had a plan B in the back of their mind. That is why a survey is uber important. Okay, and that is literally this week. Another example, going back a month or so, where the builder the house has been sold, and we got a survey done, different surveyor in this case. Survey report went back, a lot of structural issues, a lot of problems with the property, and the clients got the house for 100 grand less. Okay, so just bearing in mind that these things can work to your advantage. Okay, that's just in the last couple of weeks alone. Okay, in terms of surveyors, you shouldn't be paying any more than 300 to 500 quid for that initial survey. Following on from that, there might be things that the surveyor will identify: getting the gas boiler serviced or checked, getting the plumbing checked, getting the electrics checked. They're extra call outs that an engineer isn't going to be qualified to do, but they'll identify that the issue may be there. Little things that if you're going to spend 400, 500, 600 grand on a house, you might as well spend 400, 500, 600 euros to make sure that you're not going to be spending 50 or 60 grand later. Hopefully that makes sense. Okay, we're uber cautious on that with clients on every single deal. We assess properties with our clients to make sure that they're not missing something. Okay, you're moving on now. All's going to plan. You're at the loan offer stage. Contracts are sent to the solicitor. The loan offer is sent to the bank. I've given a screenshot there. Hopefully you can see it, of an example of costings. This is a solicitor who's charging $850 for their fee, their conveyancing fee. But on top of that, you'll see you'll have miscellaneous phone calls, photocopy and postage. You'll have outlay. You'll have searches. You'll have stamp duty. You'll have registration fees. That's registering the mortgage with land registry, folios, declarations. On top of the stamp duty, which will be 2,800 euros. The cost to buy that house for 280 in this example is 4,980 euros. So that's on top of my 28 grand deposit. So if I'm buying that house for 280k with a 90% mortgage, 28k is my deposit and 5 grand is my costs. Hopefully that's clear for everybody. And that's going to be specific to every deal. And that is going to be specific to your solicitor. So what's that 850 figure with your solicitor? Okay. And you shouldn't overpay for conveyance, and I've already touched on that. Now you're meeting your solicitor to sign the contracts. Sorry, I thought it said that already. Loan offer and the property contracts. So the title, basically the contracts to buy the house and put it into your own name. At this stage, you've paid the booking deposit of 5 grand, let's say. At this stage, let's assume the house is 300. You now have to pay the balance, the 25k. So now I'm paying 25k on top of the 5. Now you're into binding contracts. And at this stage, you are proceeding with the deal. Okay, barring something cropping up that might scupper the whole thing. But hopefully at this stage, you've identified all the weaknesses. You're signing contracts, you're paying over the booking deposit. Typically, you know, you could risk losing your deposit if you make it to this stage and pull out. Okay. We now also need to be discussing house insurance, life insurance. Which bank are you taking the mortgage with? Do you need to have a bank account open with that bank? Shopping around for discounts. I'm going to show you an example on life insurance in a moment, but why it's important to shop around. If all is going to plan, you get your house insurance in place, you get your life insurance in place, you have your up-to-date bank statements. Some banks have drawdown declarations for the mortgage to make sure you're still happy to proceed. Your circumstances haven't changed. It's specific to the bank, but we've got through that final process. We're now into final check. So we're giving the bank everything that they need, up-to-date payslip, maybe letter of indemnity for the house insurance, life insurance, balance of funds, gift letters, whatever it is that's specific on your case. The banks now assess everything at the final stage. Again, we had a case this week, should have closed last week, but the balance of funds was coming from abroad. Client had to provide bank statements showing the money coming from abroad into the Irish bank account. They didn't. They transferred them via TransferWise directly to the solicitor. So then we had to get the TransferWise statements. We had to get a letter from the solicitor confirming the money had come via TransferWise to the client, to the solicitor from the client, because we didn't get the money into the Irish bank account to show the money had come from abroad. So that delayed it getting into final checks, whereas that mortgage should have drawn down on Monday. It still hasn't drawn down today, and the client, of course, is saying she's disappointed, but she's disappointed because it didn't follow what was required. So just try and remain calm, follow the steps that we identify for you. If there's gifts, there might be what's called deeds of confirmation. All sorts of other conditions can show up in loan offers. I don't want to be given too many complicated examples, but you're now into the last 5 to 7 days. Do not book builders or book people to come in and put floors in, because you'll be disappointed, or booking people to come in and move. You just have to assume that there's going to be an overlap. There can be a delay of 2 to 3 days. There isn't a clock when it comes to this, because stuff is identified, as the example I've just given you, stuff is identified, and the banks won't issue the funds until that final process. I have another one, a top-up mortgage going on at the moment for an equity release top-up, and the bank have requested source of wealth. Again, this is a top-up on a mortgage with the bank, but how did he own his house originally? It was an inheritance. So we need to get a letter from the solicitor to confirm how the property came into their ownership originally. You'd think they'd have that from the previous case, but that mortgage, again, the solicitor's chasing, that comes back. So the solicitor now needs to send in a letter to confirm the source of wealth. That's delaying it at this stage. So the client is expecting that to draw down this week. It's going to roll into next week. So things do crop up that you just may not have been pointed out, or may not have been dealt with adequate to the final check process, which is an underwriter for the lender. Okay, all going to plan now. You're getting the funds drawn down, and you have your keys, and now you can draw a big sigh of relief and a big breath and enjoy your home. And now the crack starts when you have to get in the painters, the decorators, furnishing it if it's a new home, and even if it's a second-hand home, you have to get the thing ready now to live in. And trust me, that is an ongoing process, so try and enjoy it. Okay, so if you already own a home, you might be looking to sell it, you might be looking to keep it rented out, equity release on the home to give yourself cash to buy your new home. Again, at a meeting on that yesterday, as recently as yesterday. If you're selling, you might be in a chain that can impact your ability to buy the new house. So what that means is, I'm in my house, I'm selling my house to buy my new house, but because I'm in a chain, the people who I'm buying from may not opt for me. They might opt for a first-time buyer because I have to sell mine to buy theirs. So again, that complication can arise. Are you looking for an exception? Have you got the 20% deposit? All of these things come into it if you are moving into, you're falling into that second-time buyer or second and subsequent buyer category. If you're looking at the Help to Buy, again, it's all up on the Revenue's website. You can borrow up, so you can get a grant of up to 30k from Revenue to go towards your deposit on a new build or a self-build. Again, one of the biggest issues there is the 70% loan to value. So you have to borrow 70% of the value of the house to qualify for the Help to Buy. Okay, that might sound, well, Jesus, where are you going to get the 30%? But you'd be surprised. On self-builds is always a problem, getting the final valuation to be 70% of the money borrowed, or has been a lot of problems in the past at least. And so that's the first bit. And then the second bit is, if you've got the Help to Buy 30k, which can be 10%, you might have 20% in savings, but you do have to borrow that 70% to qualify. So just bear that in mind. So what bank is right for you? That's a hard question, and we're not going to answer that for you here today. What we are going to show you is a list of the different products out there. As I say to every client, each one of those tabs is a product. Hence why I was explaining to you, I went through 12 different variations of products with Bank of Ireland on their calculator with the client that I had, the client meeting I had last night. So again, that varies from bank to bank. Some banks don't have as many options and as many variations as others, but you can see there that there's a lot of choice. And we've highlighted different ones there in terms of rate, in terms of cashback products versus rate products. And then you have the longer term products. Well, longer term products tend to be Finance Ireland and Avant. So Avant have been brilliant on the longer term fixed products, and equally so in bringing rates down, that 1.95% for the switcher product. If you have the 60% loan to value, it's a brilliant product, absolutely brilliant product. Or if you're thinking longer term, and you don't want to have to be worried about the level of borrowing in the future, with interest rates possibly creeping up in the future, which we would suggest will happen, you might want to lock yourself in and say, okay, I'm going to pay for example, 2.75 on a 20-year fixed. Never have to worry about that mortgage again, okay, until it's gone. So there's a bit of peace of mind that might come with that. So in relation to the banks, KBC, there is a question mark. They're still open for business. We still are actually submitting business to KBC, in particular where there's stamp issues. So foreign nationals with particular stamps, KBC are very lenient on variations on stamps. Ulster Bank have more or less left the market. They rang us this week about removing our agency because they're pretty much closed for business. Okay. In terms of ourselves as a brokerage, why might you consider us as a broker? Well, we represent you. We don't work for the bank. We have our own business here, so we're representing you with the bank of choice. So we never pick a bank for your application. In fact, you collect all the documentation, you go through the mortgage process, and it's only at that meeting when we're assessing your documents do we actually decide what bank you want to apply for. And we go through the different options with you. You deal with us directly. It's on Zoom, it's on Teams, face-to-face, starting to come back into it now with clients. In terms of fees, we don't charge a fee unless the mortgage is less than 150k. If the mortgage is over 150,000, we get paid the 1% by the bank, and we're happy with that. Over the 150,000, it covers costs. We're looking to get your deal closed as quickly as possible because we get paid at the end. But again, there's never any stress or any rushing from our side. We're working at whatever speed you're working at. We've got discounting services with surveyors, with life cover, with solicitors, with engineers, with paint. We've got access to painters, decorators. I'm helping with self-builds at the moment. I've got a connection now with air to water heat pumps. So we've got a guy now who seems to be really good price-wise, competitive, service seems to be excellent. So we're now introducing him to our self-build clients. So we're always looking to provide that extra help to our clients. In terms of the life cover, I did say at the outset, I'm going to show you as an example. Let me bring it up there very quickly. This is literally from this morning's meeting. So I said, you know what, I'm going to and I changed their names obviously to Mary and John, where clients are looking at, this is a 500 grand mortgage. So not everyone is going to borrow 500. Clients are in their early 30s, looking to borrow for 30 years. So if they went with their direct bank, so who their mortgage is with, okay, yeah, Permanent TSB in this case. So if they went with Permanent TSB directly, they're going to be taking that life cover with Irish Life. And Irish Life, it's kind of hard to see there. They're coming in at 86 quid. New Ireland will be Bank of Ireland Life. So that's the alternative here, which will be 77 quid. So we just get the best price on the market. So in this case, I'm not showing the savings based on Irish Life or New Ireland, which will be significantly more. I'm just showing it on the best price in the market, which is 72. And then in this example, we get it for 58. That's the product that these clients have opted for. So it'll be 58 quid a month. And the savings on that, you're talking thousands over the 30-year period, but much more than thousands if you were to compare it with Irish Life. So I mean, if you were going directly with any of the banks, so AIB deal with Irish Life, KBC deal with Irish Life, Permanent TSB deal with Irish Life, EBS, I believe, deal with Irish Life, Ulster Bank in their day dealt with Irish Life, Bank of Ireland deal with New Ireland. So if you were dealing directly with a bank there, they're going to quote you 87 quid for that policy. You could get it for 58. They're not going to tell you that. So in this example alone, that policy will cost you 10,440 euros extra directly with the bank. That's a lot of money to pay for life cover that you don't need to pay. And then obviously in this scenario here, it'll be a little bit cheaper. Down here with the illness cover, again, you can see the variation in prices there. Irish Life 316, that's going for the creme de la creme cover, but you can see significant differences there. 316 as low as 247, 157 as low as 138. And the other insurers aren't quoting here. So you just need to be aware that what you've been told by a bank is not necessarily the best deal for you. So when I'm saying savings there of 2,800 to 5,000, I could easily have put in their savings of 5 to 10,000, and that's just the life cover. Okay, in relation to things like legal fees, you know, the air to water heat pumps, I'm after explaining, cleaning companies, landscaping companies. We have a guy who puts cabins in gardens. He's done my own garden, so I can stand over his quality and the speed and the price, but the price has gone up obviously since I've done it. But again, top class creative landscapes, the company. Plumbing and heating company, again, we use them personally and for clients. Building Matters is one of the engineers. So there's loads of companies there and partners that we can provide you access to. So I have a couple of minutes here to the very end. Let's see if I can show you an example of a calculator here. So this is a second and subsequent buyer. So a second time buyer, they're looking to borrow 340. They're selling a house to come up with the deposit. So these were the clients where we had an issue with PRA. So they have a mortgage here. They're going to have to clear the loan to provide them with the PRA in addition to savings. And the savings isn't really their savings, it's savings for their kid. But we're going to use it to give them the PRA. Because if I took that savings out, then the deal isn't going ahead. It is that simple. And they didn't even disclose it, that they were saving the money. I identified it on the bank statements when I saw this regular payment. What's that money going to? It was going to a credit union statement that they hadn't provided to me. And that is required to get this deal over the line for them. So what's going on here? You know, 4 kids, childminding. You have to put in the details of the kids. Born 340. The rate would be the 2.25. That's no cashback product. Or you go 2.5 with a cashback product. This is PTSB, obviously. Salaries go in here. If you have overtime or bonuses, these clients have overtime and bonuses, but I didn't include it because we don't need it to support the case. It's extra. So the loan is there, but that's going to have to be cleared. So you can see down here that they're passing. But even though they pass down here, the PRA test, they have to pass here. So they can pass down here. Yeah, great. But they're not passing up here based on their 6 months income and expenditure. That deal isn't going ahead until they can show it over a 6-month period. That's an example. So let me show you another one. This is a exception example. First time buyer, single applicant, civil servant on a middle of the road civil servant job with one of the government agencies on 61k. With a couple of the banks, we could push him up 2 points in the salary scale if we wanted to. He's looking for an exception because he wants to get a house for 400k, and to get that house, which is a new build at 400k, he needs to be at the 70% loan to value, which is the 280 figure. Okay, so for us to get him, for him to qualify for the help to buy that house, he needs to get the 70% LTV. So we need to apply for an LTI for him, loan to income exception. That's gone into the bank. So what are you looking at here? It's a green rate 3-year fixed, 60 to 80%. And he's not passing here because it's an LTI exception. It's gone outside of the what they call the prudential, macroprudential limits. So we have to apply for that exception. It's in with the banks. Strong case overall because his PRA it's actually much more than 2k because he's got income coming from other sources as well. But overall, it's a strong application. But that's an example of a loan to income exception. And I had a third one done for you there. I don't. This is just an example of how the calculations work. So again, you'll have hopefully seen this from me before. You're borrowing 350. You're borrowing it at a 2.5% interest rate over 30 years. That's the monthly repayment. How that's split down is of that 1382, you have the interest portion and you have the principal or the capital repayment element. So the principal, or say the interest in year 1 alone would cost you 8,600. Okay, so you're paying a lot of interest in year 1, so you don't see your mortgage dropping too much. So year 1, it goes from 350 to 342, even though you're paying 1,400 quid a month. And what happens then towards the end of that 30-year term is you can see the interest dropping. In the end of the term, your mortgage interest last year alone will be 220 quid. So if you pay 8,600 in interest in the first year, you'll be paying the same amount interest in the last almost 7 years. So you're paying the same amount of interest in the last 7 years, more or less, as you do in the first 12 months. That's how mortgages are structured. So what you're trying to do there is beat the banks at their own game and maybe shave a little bit off that by overpaying the mortgage. Finish up on this. So 5 grand every 3 years. It's not a massive amount. If I repeated that every 36 months, that would take a 30-year term down to 26 and a half. Not bad by paying 5 grand every 3 years. Just little tips that you need to, that we'll go through all this with you, and you review your mortgage every 3 to 5 years. Again, it's part of our service anyway. Can't talk about other companies. Why is that important? Because you can overpay significantly on mortgages, and it just creeps in. So, and because of the way the interest is structured, you just don't want to get caught out on that. So that's it, guys. So if you want to reach out to us, I know some of you have reached out since last week, so we'll engage with you. Thank you very much for that. But there's no urgency, there's no panic. It's complimentary as part of the Umbrella Wellness. When you're ready, book a consultation on the website, drop us an email at Symmetry Financial. Myself or one of the team will reach out to you, take you through what's involved. No questions, which is either a good or a bad thing. So either I was clear as mud, or bored you all to tears. But if anyone has any quick questions, throw them up there. Otherwise, I'm going to bid you all afternoon, and enjoy the stormy weekend. Okay. Question on switching. Okay, you want to throw it out there very quickly? S. McKeown. He's typing away now, and he's making sure he doesn't do any typos while all the eyes are on what the question is. No pressure. Anything else I can throw out at you there? Yeah, there's going to be the shared equity scheme coming out probably over the next 3 to 6 months. That'll be applicable for first-time buyers. So bear in mind that's going to be happening. There will be limits and rules around it. If you want a little bit more information on it, there's a guide done up on it. You can Google it, you'll find it. If you can't find it, come back to us, and we'll send it on to you. Listen, if the chap who has a question on switching wants to reach out to us directly, Sinead, how do I go about this? I'm with KBC. I wonder if I can go to a different lender even though I'm fixed. Okay, so I'll only answer this one and then we call it a day. If you are with an existing lender and you want to switch, you can switch at any stage. If, however, you're in a fixed period, there may be a breakage fee. So what you do, first and foremost, is you pick up the phone to your existing lender, in this example, KBC. You ask them what the breakage fee is. If it's 0, then on you go. If it's 3 or 4 grand, then you have to decide, is it worth your while switching now or waiting until that breakage fee reduces, or until the end of the fixed period. Sometimes the breakage fees will be 0. Sometimes there'll be a couple of £100. It does depend on the term remaining on the fixed period and the bank and the rate, and the overall term of the loan. Okay, there's a formula that's used to work it out. Okay, guys, with that in mind, thank you very much, and bid you all a good day. Take care now.